All right, family, we're going to go ahead and get this show on the road. We're going to pick up where we left off last week with part two of breaking down trash value life insurance, right? Trash value life insurance. Did you guys enjoy last week's training? Let me see your hand if you were here last week and stuff like that. Yep, you got something out of last week. All right, good stuff. Did you learn something last week? Did you hear some things, or did you see some things that kind of light bulb came on and you were like, man, I didn't know that about that, and I didn't know that that's how it worked? Did anybody have that experience? You know, give me a thumbs up or shake your head yes, or give me a reaction emoji or something like that. That's good. Awesome sauce. I got plenty of feedback and text messages from people letting me know that they got a lot out of that training. Well, family, we're going to take it to a new height and a new level tonight. And so let me go ahead and share my screen so we can get to it. Breaking down trash value life insurance. We want to do a recap of part one, and then what we'll do is we'll jump into part two. Just a quick recap, right? What did we talk about? We started last week off saying, man, I just sense a disturbance in the force, right? I mean, I'm a Star Wars fan. And what was that disturbance, Super J, man? It's just an uptick of people talking reckless and foolish about trash value life insurance. And a lot of these people look like us. A lot of these people look like your bestie. A lot of these people might be your social media partners and friends, right? They out here talking loose and reckless and just toxic information about how that stuff is like the best thing since sliced bread, right? And that is a bunch of crap, man. All they doing is basically trying to put lipstick on an old pig. We talked about that, right? What else did we talk about? We talked about how whole life insurance works. Guys, it's just a simple recap. We talked about how somebody can have $175,000 in coverage, paying $160 a month. Check this out. This is how this works, Mia. Part of that $160 will go to pay for the cost of insurance. That stays the same. The other part goes into a separate account, which they call the cash value, or they refer to it as the savings. And the way that that thing works, we said that the savings is designed to be approximately what? 50% of the face amount by the time the client turns what age? Does anybody know? Did anybody tell me? By age 65. So if a person has $175,000 in coverage, the way that they structured the premium, they want the cash value, which is the savings inside of the policy, to be approximately, it might not be exact, but approximately half of whatever the coverage amount is by the time a person turns age 65. That's how those policies work. Now, in addition to that, this is where they get people right here with that savings. They said, hey, you can use that money for emergencies, kids, college education, and all that type of stuff, vacation, investment. And this is where they're getting people right here. This is where they're getting people. They trying to make that whole savings portion seem like it's got a cape on, and it can be just, you know, it can fix your car, it can do your dishes, it can put a new foundation on your home, a new roof on the house. Man, they trying to build that thing up to where it does everything. And that you don't need a 401k, you don't need an IRA. Man, you got people that are out there that don't have a securities license, that don't have an investment license, that's trying to tell your cousin, that's trying to tell your aunt and your uncle and your best friend that all they need, the only financial product they need, is a whole life insurance policy. And they're lying to them. And we were talking about that last week. That's what's going on, right? And so these are some of the things that you say when someone has a whole life policy. We talked about the language, guys. Just a recap. These are things that you ask. Hey, who, the person who sold you this policy, are they a family member, friend, or just a regular person you had no prior relationship with? That question is important because you need to know who was the person that sold them the policy. And that way that gives you intel on how to approach it. Because if there's a connection, a family tied to them, then you're going to have to really tread lightly and delicately when you start breaking down how the policy works, because, man, it might be a sibling that sold in that policy, or their favorite uncle or aunt, or the pastor's wife, the first lady of the church. Man, so you just need to understand. That way you don't go in there just really running roughshod over a relationship. You need to have some finesse about that, all right? Then after you ask that, well, first, let me commend you for having life insurance outside of the job, because most people don't. By having it, That says a lot about you and how responsible you are and how much you love your family. You want to commend people. You want to congratulate people. You want to recognize people for having coverage outside of their job. Why? Because most people don't. That's the truth. And you let them know that, hey, you did the right thing, but the right thing wasn't done to you. You did the right thing, but unfortunately, what you were sold, the right thing wasn't done to you. You ask them, hey, did you buy this policy for protection? Check this out, savings or both? Protection, savings, or both? Why are you asking that? Because you need to know why a person bought the policy. What are they looking for? Did they buy this for a savings? Well, this is an awful savings program. If they bought it for protection, 9 times out of 10, or I should go on a limb and say 10 times out of 10, they're going to be underinsured with a whole life policy because those policies are so expensive. Most people don't have enough coverage, barely to even cover the funeral, not to pay off any debt, not to leave a legacy. And then you ask, hey, did the agent explain the savings portion and how it works? They're probably going to say no, or they're not going to remember what they share. Then you say, when you have this type of policy, you actually have a life insurance and a savings bundled together. Now, we believe in the same thing, having insurance and savings, but we believe in keeping them separate. Why? Because unfortunately, when you bundle, I'm going on to the next bullet point. When you bundle life insurance and savings together, Catherine, you give up control of the savings portion of the policy to the life insurance company. What does that mean, Mia? Mia, that means that the insurance company has the audacity to start treating your money, which is the savings, like it's their money. Let me explain, Sadaka. Let me explain. And this is when you go through the 4 evils of cash value life insurance, and you do it in the form of a story. You go through the 4 evils of cash value life insurance. Hey, who do you bank with? You bank with Chase? Okay, great. What if Chase wanted you to open up a bank account and these are the features of that account? And they say for the first 2 to 4 years, you faithfully put money into that Chase account, you still gonna show a 0 balance. The reason why you're showing a 0 balance is because the money that should be going into the savings account with Chase is actually going into the personal banker's pocket that opened the account for you. Do you like that feature? They're gonna say no. And I'm shaking my head no with them. Okay, well, if you can stand that, what if they tell you this? Once you do start showing a balance in that account, you can't do a withdrawal. You can't take money out of the account. You can only take a loan. You can only borrow your own money and pay Chase 6 to 8% interest back on the money that you take out of your account. Isn't that crazy? Do you like that feature? No, they won't like that feature. But then here's the kicker. Your money will grow, but it's only going to grow at about an average 2 to 4 to 5% rate of return. So if you take money out of your account, they're going to charge you 6 to 8% interest, but then you only going to make about 2 to 4 to 5%. Do you like that deal? No, I don't. Who does that benefit? Does that benefit you, or does that better benefit the bank? That benefits the bank, right? And then here's the kicker. Check this out. Raquel, if you pass away, if the unthinkable happens, if you pass away, if you have money in this particular type of Chase account, Chase is going to keep that money. They're not going to pay that money out to your family. Whatever money that you have in that Chase account, they're going to keep that money. Now, here's the question. Can any bank on the planet, Chase, Bank of America, Wells Fargo, any credit, can they convince you to open up that type of account? Probably not. Because who does that account benefit? Does it benefit you, or does it benefit the bank? It benefits the bank. But the bank is trying to tell you that that's your money. It doesn't feel like it, right? So 9 times out of 10, you wouldn't open that account, but that's exactly how a cash value and how the savings in a whole life policy works. All you got to do is just switch the bank out for a policy. For the first 2 to 4 years that a person has a whole life policy, they're going to show a 0 balance in the savings. A 0 balance. Where's the money going? I'll tell you where it's going. It's going to go into the agent's pocket that sold you the policy. That's why they sold it to you, because they make the most commission off of that type of policy. That's how it works. They didn't tell you that, or they didn't explain it to you like that, but that's how it works. And then in addition to that, once you start showing a balance in there, that money when you try to take it out, you have to borrow the money. You have to take a loan out of the money. See, you've heard people say in the past, hey, I'm borrowing against my life insurance policy. You even hear people out there talking about it. Hey, you can be your own bank and borrow. Like, that's crazy. That's crazy. Why would you borrow your own money and have to pay the life insurance company back interest on your money? That's your money. That interest doesn't get credited to you. It goes to the insurance company. And then the money that's in the whole life policy, it's only going to grow to about 2 to 4 or 5%. And then here's the kicker. If you die, whatever amount of money that's in the cash value, they consider that a living benefit, not a death benefit. So the insurance company keeps that money that's in the cash value when a person passes away. I'm telling y'all, that's how it works. And knowing this, would you buy this type of policy? When you ask most people that question, they're going to say, no, I would not. And I'm telling you right now, a lot of your family, friends, if they have coverage outside of the job, they have that particular type of policy. And they don't even know it works like that. They don't know until you show up and you're able to share that with them. We got that so far. Everybody's good? We're just doing a recap. Recap from last week. What else we got? All right. We talked about what to look for in a whole life policy. When you have a person's policy in front of you, or you have some things in front of you to look at, you want to verify the type of policy they have. Make sure that it is what it is or what they think it is. Who's insured on the policy? What's the insurance rate class? The coverage amount, which is the face amount. The policy issue age, issue date. What's the monthly cost? What is the cash value interest rate? Policy loan interest rate, cash value accumulation table, and death benefit provisions page. You want to be able to find each of these things and be able to show the client some of these things so that way they know and understand what they have, right? So this is an example of a policy I showed last week. This is a MetLife policy, right? As you can see here, this is a whole life policy. Follow me on this. It says life insurance, not cash value in life insurance, but life insurance is payable when insured dies. And let me say this, family, Justin said it last week. I don't care what your agent told you or what the agent may have told your person that you're sitting down in front of, whether they're a family member or friend. Don't care what the agent told them. The policy is only going to do what's in black and white. The policy is only going to pay and do what's in black and white. All right. And so look at this right here. Their monthly premium for this whole life policy is $121 a month. This is on a 28-year-old male, right? Policy was issued back in 1993. Look at this. For the first 2 years, this is the guaranteed interest rate. This money's going to grow at about a 4% when they do the cash value. But look at this cash value accumulation table. You see guaranteed cash value. What does that say for the first 2 years? $0 in the cash value. After they have been paying $121 a month for 3 years, they have a whopping $150,000. I mean, sorry, $150 in the cash value year 3. Can you all see that? Y'all can't tell me that that ain't crazy. Y'all can't tell me that, man. That's crazy.
Thank you.
That's crazy. That's crazy. Omar, you had a comment?
Yeah, I was going to say, hey, man, great training last week. I watched the recording. It was fantastic. But I want to see if you could take a few minutes and then kind of explain to the rest of the group here what that page actually means. If you don't mind, put that up again.
Put it up for you, brother.
Thank you. Basically, what that means, just to make sure everybody is very clear, the insurance company actually gives you options on how not to pay you the cash value. So if you zoom in, just pick one line, Nick. Pick whatever line out of that.
Let's say put this line right here in 6,900 right here.
So what that means is, Nick, if you wanted to cash out, that's the cash you would get, right? But let's pretend the whole life agent. So what they're going to say, Nick, if you take all the cash value out, you're going to be left uninsured. And you don't want to lose everything, don't you? So like, yeah, doesn't make sense. Why don't you use another option that we have, which is follow the same line on the right, Nick, which is what, 27,000?
27,000.
So this is what we can do, Nick. If we keep your cash With that cash, we're gonna give you $27,000 worth of coverage until age 100 that you don't have to pay any premiums anymore. Doesn't it make sense that instead of you losing all your coverage and everything, you keep a $27,000 whole life policy that you don't pay premiums on? Don't you think that's a better idea than just cashing out?
Crazy.
But if you don't like it because you used to have 150,000 in coverage, no problem, Nick. Forget about that option. This is what we're going to do instead. We're still going to keep your cash and we're going to give you a term policy for 13 years and 125 days. But we're going to extend the original $150,000 worth of coverage. What are they really trying to do? They're keeping your cash and give you two different options so that way you leave the cash with them. I just wanted to explain that, Nick.
So what he was breaking down is you hear people say that I have a paid up policy or all of this type of stuff. So he's talking about these paid up additions that show up in people's policies. People say, hey man, my life insurance policy is going to be paid up in a certain amount of time, in a certain amount of years and all that type of stuff. There's no such thing as a paid up policy. What happens is that money is coming from somewhere. They've overcharged them in a crazy way in order to get to that paid up part of the policy. And so it's just one of those things, guys, and just knowing what to look for and how to explain these things to clients that you got to be aware of. And that way you understand that when you do show a client that this stuff jumps off the page to them, because you don't have to embellish. You don't have to make anything up. This stuff that we're talking about is literally in black and white. It's right here. It's right here. And so you see that page, right? $0. And then this is the policy loan page. It's talking about the loan interest rate, right? You know, hey, you can get cash from us. It says you can get cash from us. Man, ain't that supposed to be your money? Now they talking about, man, this our money. You can get cash from us by taking a policy loan. What are we talking about? That's supposed to be your money. They're treating your money like it's their money, right? And then look at this. The loan interest is charged daily. This is in this particular policy. They're going to charge you interest on the loan, and that interest is going to accrue daily. And the formula that they give is going to be something crazy. It's basically going to be whatever interest rate they want to charge you. And then here's the kicker. Payment when the insured dies. It's the face amount. It has nothing to do with the cash value. It's the face amount of the policy. The cash value is not included in that. All right. And so these are just some things, taking a policy loan from us. It's just language that they got. Look, man, they talking about you borrowing your own money, just craziness, right? So that's the recap. That's the recap from last week. It's out there on the YouTube page. Check it out, dig into it, get into it. But we're moving on to part 2 this week. And in part 2 of this week, family, check this out. We're going to tackle universal life policy. So there was a trend in the insurance industry where in the early stages of insurance, check this out, man, they sold whole life in the 50s, 60s, and 70s. It was nothing but whole life insurance. But in the 80s, something came about called universal life policies. It's a form of cash value. Basically, it's just building on top of, it's the same whole life type policy, but they just added some new features to it. They added some things to it, Catherine. And so that was the 80s. And then in the 90s, they came out with what's called variable universal life policies, right? To where the cash value savings was attached to an actual investment, like a securities, a mutual fund and things like that, a variable universal life. And then in the early 2000s, they came out with this return of premium type of policy, a return of a premium term policy. They called it a term policy, but it's not a term policy. It's really a whole life policy in disguise. They just called it a term. It's called a return of premium term, right? But that's not what it is. It's really a whole life policy in disguise. And now what's going on is that you have what's called index universal life. Index universal life. Those are the policies that they're slinging right now, that they out there pushing right now. Index universal life. But it all stems from whole life insurance. It's just a different version of it. It's just building on top of the same whack foundation. Whole life, universal life, variable universal life, return of premium term. Now you got index universal life. And so that's what's rising right now. And so let's get into part two. And so what we're going to talk about is universal life, because you need to understand how that works. It works very similar to whole life insurance. It's just a little bit different, right? And so this is how a universal life policy works. Just follow me, right? Let's just say that a person has $500. It's going towards their coverage, right? So this is what the premium is. The monthly premium is for a universal life policy. It says $500. So part of that $500 goes towards the cost of insurance. Now the insurance portion of a universal life policy is actually an annual renewable term policy. What does that mean? That the coverage stays the same, but the cost of the insurance goes up every year. It's called an annual renewable term policy. So that's the insurance portion of a universal life policy. So the cost of the insurance goes up every year, but the client doesn't know that. Y'all just missed it. Y'all missed it. The client doesn't know that the cost of insurance goes up every year. Why? Because they were told to pay $500 a month. So a portion of that $500 goes towards the life insurance. And that cost, just like that arrow is pointing, it goes up every year. Cost increases yearly. Then you have a nice portion of that $500 that goes towards miscellaneous fees. See, these policies have fees, high fees, policy fees, administrative fees. They come in various labels and they nice size fees. These fees pretty much kind of stay the same. But then you have the separate account, which is the cash value or the savings or whatever. And so part of that $500 goes into that cash value separate account, that savings account. Initially, the account is set to increase, but later, the savings of the cash value will start to decrease. The client doesn't know this though. Initially, when they first get the policy, the account will increase, but then later it'll start to decrease until the policy terminates. And from the savings account, these policies also have what I call nasty surrender charges. Nasty surrender charges. I'm talking about make you want to fight somebody with your fist and your feet. You know, you really want to fight somebody when you want to fight them with your fist and your feet, right? Nasty surrender. See, y'all think I'm playing. I'm going to show y'all here in a minute. Nasty surrender charges where they just basically, Cam, just take your money. Just take your money. They just take it. And it ain't nothing you can do about it. They just take your money. You like, that's mine. No, it's mine. I'm going to take your money. And they call it a surrender charge. It's the craziest thing. I'm going to show y'all here in a minute. And so the savings portion, it increases initially, but later it will decrease until the policy terminates. So it'll go up at first, and then it's going to go down until the policy terminates, right? And so what does an enemy agent say? What are some things they may say to sell universal life insurance? Well, let's go over it. Hey, this policy is designed to be a permanent life insurance policy, right? You don't have to worry about, you know, anything and stuff like that. Yeah, man, this is the last policy. This is policy going to be permanent, right? You had this for the rest of your life. This policy offers a lot of flexibility. What do you mean? That means where it allows you to adjust the premium amounts you pay. You can pay a high premium, you can pay a low premium, right? You can adjust all the things about this policy. You can adjust the face amount if you want. Man, you can do it on the fly. That's why they call these policies, they're universal life policy, but they go by another name called flexible premium adjustable life. They go by another name. Flexible premium adjustable life. When you see any policy that says flexible premium adjustable life, Catherine, all you gotta know is that that's a universal life policy. That's a universal life. Sean, when you see that flexible premium adjustable, yep, flex this, blah, blah, that's a universal life policy. And you're gonna be like, I'll be daggone. That's what that is. Right? Flexible premium adjustable life. Should just say stole your life. All right, okay. Enemy agent might say, hey, this policy builds cash value. The cash value works like a savings. You can use the money however you want. It's best to pay more premiums than required so your policy can build cash value faster. The policy is saying that the minimum payment, it's best that you pay more. You can pay more. You can load up in this thing. Matter of fact, do you have any money to start it with as a lump sum? This is what the enemy agents are saying. And some of y'all shaking your head because y'all already know. This is how the game works. They might be asking your people, your family members, to cash out their IRAs, to take the money out of their savings. $10,000, $15,000, $20,000, and let's front end load this thing so I can get paid. I mean, I'm sorry, so you can load up on see, that be them Freudian slips. So I can get paid. Oh, no, I'm sorry, I didn't mean to say that. So you can really get a head start on building your cash value. Wink, wink. No, so they can get super paid. Telling y'all. Every time you pay your premium in a universal life policy, it's like you're building equity in your policy, just like you do every time a person pays their mortgage, they're building equity in their home. Might have something negative to say about term. And then the cash value is liquid. You can use it however you want to. You can use it for emergencies, kids, college education, all that type of stuff, blah, blah, blah. Ooh, one premium payment, you get all these benefits and the money is tax-free. All these things that they're going to be selling and telling and all that type of stuff. But this is what you say. You say the same thing that you say when somebody has a whole life policy. Hey, the person who sold you this policy, does it sound familiar? Shake your head yes if it sounds familiar. You ever do? Hey, I got you. Hey, the person who sold you this policy, are they a family member, a friend, or just a regular person you had no prior relationship with? Because whether it's a whole life policy, a universal life policy, flexible premium adjustable, you know, karate policy, whatever the case may be, whatever they want to call it, you need to go through the same list of questions. Same list of questions that I talked about in the whole life policy. So I don't have to go through all of those. I just went through them. What else do you say when someone has a universal life policy? This is what you need to do. You go through that banking example explaining the 4 evils of cash value life insurance. You go through that talking about, hey, you know, would you want to open up this type of account and blah, blah, blah. They're going to say, no, 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 no. Well, that's exactly how the savings portion of your policy works. But your policy has some other things going along with it. These are the other things you want to say. You want to explain to the client that these policies have what? Nasty surrender charges that are designed to take the client's money. These policies have surrender charges, Mr. and Mrs. Client. I'm going to show you that in a minute. And those surrender charges are designed to try to take your money if you want to leave this policy. It's designed to hold you hostage. Hold your money hostage if you want to leave this policy. That's really what it's doing. It's holding the money hostage. You explain how the insurance portion of a universal life policy, what is it? It's an annual renewable term policy, which means that the cost of insurance goes up every year, but you don't see it. And explain that how some point the policy will reach a breaking point. What does that mean? That means that the cost, because some of y'all are already getting it. Well, Nick, if the cost of insurance is going up every year, sooner or later, it's going to be more than the monthly premium that the client is paying. Isn't that right? You are correct. That's called a breaking point. At some point, this policy is going to reach a breaking point where the cost of insurance over time is going to be more than what your monthly premium is that you're paying. And then you ask the client, where do you believe that cost difference will be taken from? Do y'all know where that cost difference is taken from? From the cash value. The client doesn't even know it. They don't even know it. And so when it reaches that breaking point where that cost of coverage is going up, but their premium is down here, they're siphoning off the money that's from the cash value, and they're draining it until it gets down to zero. And when the cash value is at zero and there's nothing else to siphon off, guess what that insurance company is going to do to that client? They're going to send them a nice, nasty letter that says, hey, Mr. and Mrs. Client, your new monthly premium is now, and if you don't start paying that new premium this month, your policy is going away. And I'm going to tell y'all something, that monthly premium number is going to be such sticker shock to that person. They're going to be like, what? No, I can't pay that. And they're going to call the insurance company and say, what is this about? Well, Mr. and Mrs. Client, this is what's been going on with your policy over the past 20 years. Your cost of insurance is going up. Nobody told me that. Yep, that's how your policy works. It's in the language of your policy. They're going, and your client gonna say, well, man, I don't want it no more. Just give me the cash value. No, no, no. There is no cash value. What do you mean there's no cash value? For the last 5-7 years, we've been taking the difference in premium from the cash value to offset the cost. Nobody told me that. That's what's been happening. And so now you have no cash value. And from what I'm hearing, you can't afford to pay the premium at that high cost. Well, that means that you no longer have any insurance. And so we call that imploding. Imploding.
Hey, Coach.
Yes, sir.
Man, real live situation. Like I mentioned, my barber, y'all. The policy he had was a variable universal policy. He had it since 2000 and I want to say 9 or 2011. It was at least 10 years that he had the policy. So he was just like, I'm paying $109 a month. And I was like, he was just like, and I've been paying that every month. My premiums have not gone up. He was like, it's 109 each month. I know exactly what it is. I'm like, okay, great. And so I'll tell y'all one thing, that I can respect a company that will charge someone annual renewable term if they let them know up front and the person agrees to it, right? They say, okay, you told me what it was gonna be. Every year is going up, and I know it is. I accepted that. But I really can't respect a policy or a company, right, that will charge someone the same thing, and as they get older, they secretly go into the back door and take money out of their savings year in and year out, right? So the breaking point for this client was when he saw down the road, which is really not too far from now, in his 60s, how it would have went from 109 a month. It was upwards of $2,000 a month. 2,000, and then it kept going up. And I was like, and that money was going to be coming. I was like, can you see now how that cash value will deplete very, very quickly, right? Because people are living longer these days, right? And so, but he really was invested in that policy. He was like, the insurance piece, that's my insurance. The savings part, that's my investments, right? He owned a business and everything, right? And people that really make, quote unquote, really have really great income, they get preyed on the most. Like, they get sold these type of policies all the time. And so I didn't really have to go any further than the annual renewable term piece, Nick. That's all I really had to break down for him in his policy so he could actually see it. And when he said out of his own mouth, this is not a good investment. That's when I knew class was dismissed. So I could actually offer him something better, right? And so he was cutting my hair the other day, and I know I need one today. Don't worry, next time I have, don't worry. But he said, man, I thank you. He told me, him and his wife, they both thanked me. They was just like, you don't know how many people actually come in here trying to, you know, push stuff down and sell us stuff and do this and do that, right? So the approach had to be right. But also you have to be educated about what you're actually bringing to a client. You got to know your stuff, right? Because you don't want to get put in a position where you become the student and you're supposed to be the teacher, right? I mean, you really gonna walk out of there with your tail between your legs. You know what I'm saying? Like, man, I just got served for real. But so that's why it's good to know your craft, right? And you go in here and you break this stuff down, and and the families will be all the better for it. And you can be excited about what you do. So yeah, that's what I want to say.
Powerful. Very, very powerful. And so it's out here, y'all. It's out here. And these types of policies, universal life policy, they get sold to the real educated people, the real professional folks, like the doctors, dentists, lawyers, engineers, you know, business owners and all that. Like, those are the people that might show up on your chicken list, you know. And what I mean by chicken list, these are people that you're scared to talk to, people that might have status, people that might have title, you know, that we think got it together. There's a high likelihood if they have life insurance, because a lot of them don't even have life insurance outside of the job. I'm telling you, you all will be surprised. If they do, they have some form of this type of policy that's been sold to them, because some crazy illustration was ran and they tell me, I can get this money tax-free, and they getting taken for a ride and they don't even know it. And so what else you say? Hey, you explain the cost difference gets taken from the cash value. And you also explains that once their cash value is completely depleted, that their policy will implode if they don't pay a ridiculously higher premium. These are the things that you got to explain to the client. And you don't just explain it to them, you show them in black and white. So what do you look for in a universal life policy? Similar to what you look for in a whole life policy. Verify the type of policy that it is. It will never be called a universal life policy. Rarely will it be called that. It'll be called more than likely a flexible premium adjustable life policy. In some occasions, you know, if they're getting fancy, they'll call it a universal life policy, but mainly it's called a flexible premium adjustable life policy. Unless it is an index UL or IUL, that's an index universal life, or a VUL, variable universal life, it'll be called that. But most of the times, if it's just a universal life policy, it's called a flexible premium adjustable life insurance policy. So who's insured on the policy? These are just things to see. Insurance rate class, coverage amount, issue date, and issue age, cost. What is the premium? This is a big one right here. Death benefit option. Can you all see that? Death benefit option. This is not on a whole life policy, but this is on a universal life policy. There's two different death benefit options on a universal life policy, Mia. You have option 1, and then you have option 2. You have option 1 and you have option 2. Sometimes, Mom, they'll be called option A or option B. Option A. Give me a thumbs up if y'all are with me, because I need y'all to hang with me on this. Give me a thumbs up if y'all are with me. So here's the problem. When a person has death benefit option 1, which is going to be probably 95% of the people that have this type of, they have death benefit option 1. Death benefit option 1 does not entitle their beneficiaries to the cash value when they pass away. They only get the face amount. Death benefit option 2 actually allows the beneficiaries to not only get the face amount, but also to get the cash value. Here's the challenge. Death benefit option 2 is so high up there. It's so high. Has anybody ever seen Shaquille O'Neal in person? I'm talking about, have y'all ever been up on Shaq in person? Man, Shaq is a giant walking the earth. Man, he is so high up there. That's what option 2 premium is per month, Catherine. It's so high up there. You'd be like, man, that's high. Like, so most people They don't choose death benefit option 2. Most agents don't even quote death benefit option 2, Queen. Why? Because it's too expensive and people won't get it. So they do death benefit option 1. Death benefit option 1, the beneficiary will only get the face amount, the coverage amount. They will not get the cash value. Death benefit option 1, death benefit option 2. All right. Everybody got that? Give me a thumbs up if you got that. All right. So, because we're going to see some examples here in a second. Policy loan interest rate, surrender charge table. Now, I should just put nasty on there. Nasty surrender charge table. I'm going to put that out there. Cost of insurance table. And then you're going to see a nice little note. I put note in quote, nice little note that says the policy will implode. Check this out. Alicia, do you know that they actually have a note in a universal life policy that's going to say something about that policy going to implode? Now, it won't say that, but it's going to say that. It's a nice little note that's in there. It might be buried in some fine print somewhere, but it's in there and you can find it in the policy. Y'all ready to look at a universal life policy and see what one looks like? Okay, I don't pull it up. This is what one looks like. Check it out. So this is one from a company called Indianapolis Life. See, right off the top, off the ripper, flexible premium adjustable life insurance. We already know this is a universal life policy. Flexible premium adjustable life, universal life policy. We already see the coverage amount is $428,265. Y'all heard me joking last week. See, when a person got a universal life policy, they're going to have $138,179 in life insurance. It's going to be some weird number. Like, how did they get, you know, $195,348.27 for life? Like, how did they land? Did they quote that? Did the client ask for that? No. What they did is they asked the client, what can you afford per month? And they said, I can afford $250. Okay, for that $250, I can give you $203,744 in life insurance. And that's how they got that weird number. That's how that number comes up. Trust me, the client did not ask for $428,265 in life insurance, right? So this is the issue date, November 1st, 2003. We got that. All right. So let's look at the policy. So check this out. This person, this is a minimum premium payment. They're saying, hey, if you pay a minimum premium payment, a monthly premium payment of $351.24, you can keep the policy for 15 years. That'll be enough to keep the policy in force for 15 years. But if you pay a minimum premium payment of $323.05 a month, it'll only keep the policy in force for 5 years. Nick, what are you talking about? Remember, what's going on with the premium every year? It's going up. So they telling you, if you pay this much per month, this policy is going to implode in 15 years. If you pay this much per month, this policy is going to implode in 5 years. See, they ain't saying it, but they saying it. Are y'all hear me what I'm saying? It's right there in black and white. It's right there. So what is this client paying per month? See, this is the minimum payment. What is this client paying per month up here? They paying $6,000 a year, which means that they paying $500 a month. They paying $500 a month for $428,000 in life insurance. That's what they pay. What else going on? They're a tobacco user. Let me get somebody to go back on mute. Here we go. There we go. All right, check this out. Here's the nice, nasty note that I was telling y'all about. Hold on. Oh, I didn't circle it. This is the nice, nasty note. Here it is right here. Here's the note. It is possible that coverage will end before the death of the insured if either no premiums are paid after the initial premium, or if the subsequent premiums are insufficient to continue coverage for the lifetime of the insured. Are y'all catching that? That's the nice nasty. That's the nice nasty note that's in the flexible premium adjustable universal life policy. That's what it is. And so you want to look for that note and you want to find that note. That's what you want to do. That's what you want to do. That's that note that I was talking about. Everybody got that? Give me a thumbs up if you got that. All right, perfect. And then what else going on with this policy? This is the death benefit option. Check this out. This is death benefit option 1 and 2. Look at death benefit option 1. Death benefit option 1. The death benefit is calculated as of the date of the death of the insured and is the greater of the face amount or the minimum death benefit described below. Basically, they're just saying, hey, it's the face amount. It's the face amount. That's what that is. Option 2 says it's the face amount plus the account value. That's the cash value. But that's not death benefit option 2. That's not death benefit option 1. Death benefit option 1 is just the face amount. And what's the death benefit option that they have here? They have option 1, which is only the coverage amount, not the savings. See, most people have death benefit option 1. Y'all remember me talking about the nasty surrender charges? Here they go right here. Y'all see this surrender charge table? What's the surrender charges in year 1? $8,578. In year 2, they go down to 8,000. Guys, if a person has any type of money in this policy after a year, the company basically saying you can't get none of this cash value out because we're going to charge you 8,000 something. So if you got money in this policy, we're going to keep $8,000 of that money. That's your surrender. Am I the only one that think that that's crazy? That's supposed to be my money and they saying that they're going to keep 8 racks of money. See, y'all think that this is made up. I'm going to show y'all a real life example here. Loan rates, all these fees, surrender charges. They got a surrender charge scale for 15 years on this deal. 15 years they're going to get in your pocket for your money that's in this policy. And then this is the life insurance rate table. This shows you every year. See, this person's paying $500 a month. So what you do is you take whatever the coverage amount is and you multiply it by this rate. So if a person has 428,000, you take whatever the thousands of that rate. So you take 428 and multiply it by this rate right here, this 0.32367. And that's what you get. That's the cost for the insurance portion of the policy. That's the cost for the insurance. And so at age 34, they're paying $500 a month, but check this out, Sean, the insurance portion is only $138.53. The rest is going towards fees and supposed to be going towards the savings. But as you can tell, these rates go up. In year 5 of the policy, now the cost of the insurance can went up to $195. Are y'all catching this? Let me stop sharing. Can y'all see this? See, in order to be able to do this, you got to do a little math in the policy. So if you have a policy in front of you, you're going to have to find this table. You'll do a little math and you'll be able to work this out. In year 10, while the client is 43, now the cost of insurance is $306. And 11 is $329 at 44. At 45, now the cost of the insurance is $354. In year 15, when they're 48 years old, the life insurance portion of their premium is now $435 a month. Now, this client is still paying $500 a month. They're not knowing that their insurance is going up. And that's when it hits them, man. Year 17, Justin, that's the break even. That's the break even. And it's all downhill from here. In year 20, they paying $627. 16, where they taking the difference from? From the cash value they accumulated over the past 17 years. By year 25, the insurance portion is $958.10 if they make it that far. And this is where that nice, nasty note comes in. It is possible that coverage will end before the death of the insured if no other premium are paid after the initial premium, or if subsequent premiums are insufficient to continue coverage for the lifetime of the insured. That's how they do it. and they'll send him that letter. So let me show you guys an example, right? So we're going to call this guy Kelvin Brooks, right? This is an example based on my best friend. Now, that's not his picture and that's not his name, but this is his situation. This is my best friend. He's been my best friend since my sophomore year in college. We were roommates in college together. He was the best man in our wedding. Like, this is my guy, right? We grew up together. We became men together. Are y'all with me? This is a real life scenario. I've changed his name and this is not his picture, but this is a real situation I'm about to show you. This isn't some hypothetical made up. We're going to call him Kelvin Brooks, right? He's 49 years old. This is how old he is now, 49 years old. He's the owner of a civil engineering firm. He's a business owner. He's a successful business owner. He's a single dad with 2 daughters. One's going into her sophomore year in college. One's going into her senior year. Is everybody with me? Give me a thumbs up if you're with me. This is Kelvin's situation. This is one of the policies that he was sold. You can see the name of the company up there called Principal, right? Financial Group. He was a preferred non-tobacco, right? 41 when he got this policy. He was 41. He got it in 2014. He has $320,000 in life insurance on this. Guys, what's his death benefit option? 1. Death benefit option 1. What's his monthly premium? $750 a month. I'm sorry, a quarter. That breaks down to $250 a month. But they put something on there. This is a way for them to ask him to overfund his premium. They call it a no lapse guarantee, Justin. The no lapse guarantee is an additional $147.20 a month. So his total monthly premium for this policy is $397.20 a month for $320,000 in life insurance. Y'all think that this is a game. This is a real situation. Real situation. Look at this nice nasty note. Y'all see the nice nasty? If sufficient premiums are paid, this policy provides life insurance protection on the insured until the policy. You may have to pay more than the planned periodic premium showed above to keep this coverage in force. He had no clue what that meant. He didn't know what that meant until I showed up and I showed him. He had no clue. Guys, if this is happening to my best friend, it's happening to your best friend. I'm telling you right now. But that's not all. Guaranteed loan interest rate, 4.5%. Right? Guaranteed interest crediting rate is 2%. But if you take money out of his cash value, they're going to charge him 4.5%. Y'all ain't hearing me. But that's not all. That's his first policy. And what does it say up here? Flexible premium, universal life. That's what he has. Check this out. This is that nasty, Auntie gonna like this. This is that nasty surrender charge table. Look at this. Guaranteed maximum surrender charges, Cameron, for each policy year shown in the table above. Look at this. For the first 4 years of the policy, Mia, they charging a surrender charge of $7,325.82. Meaning that if he try to touch his cash value within the first 4 years, they saying that I'm going to steal. I'm going to keep $7,300 of your money, bruh. If that ain't Debo, I don't know what is. He had no clue that this is how his policy was working. $73.25 for the first 4 years. Surrender charges for the first 14 years of this policy. And this is his money. First 14 years of the policy, his money. Death benefit option 1. Under option 1, the death benefit equals the greater of the face amount or blah, blah. Basically, it's just the face amount. He has death benefit option 1. So if he passed away, any money that's in his savings, insurance company's going to keep that. They're only going to pay his coverage amount. That's his first policy, right? And this is a summary page that shows what's happening with his policy. So with universal life policies, they send out summaries, right, on an annual basis. And it just kind of gives you intel about the policy. So look at this. This is his policy date. He got it in 2014. It's showing his coverage amount and his quarterly premium, $750 a quarter, basically $250 a month. Look at this, y'all. As of December 3rd, 2020, his total accumulated value was $13,260. But look at that, minus surrender charges. We ganking you. We gonna shank you. We gonna gank you. $7 grand. So his net surrender value is only $6,166, which means that if he surrendered this policy, principal is going to keep $7,039 of his money, Catherine. They only going to give him $6,166. Man, put in the chat if you feel that's some BS. No, I'm joking. Man, that's wild. But that's real. And I'm telling you right now, you know people right now that they got this type of policy and they don't even know about it. We need to talk to them. We need to show them this. But then they said, hey, in 2021, look at this. Your accumulated value is $15,747. Surrender charge kind of went down. It's only now they saying they're gonna take $62.57 from you. So now your net surrender value is $94.90. That's it. Y'all, this is crazy. I had to explain this to him. We had to go over this. And I'm gonna tell you something, man. It make you want to fight somebody with your fist and your feet. It make you want to fight somebody because that's my money. They keeping his money. But that was his first policy. This is his second policy. See, there's a company called, so I know some of you guys don't know this, but Allstate got out of the life insurance business. They sold their life insurance business arm to a company called Everlake. So Allstate no longer sells life insurance. So he had a life insurance policy with Allstate, and then a company called Everlake took it over. Is everybody with me? That's what happened. So there is no more, you can't buy life insurance from Allstate anymore. It's a company called Everlake. So this is what he had with Everlake, right? So he had a policy, he just got it a couple years ago, 2019. He's paying $500 a month for this policy. It's a variable universal life policy. What's his death benefit option? Some of y'all already seen it. Death benefit option 1. He has $408,000 in coverage. He got it when he was 45 years old. Here's the statement for it. Same policy. This is when it was with Allstate. This is the statement. So let me go walk through some of the issue date 3/19/2019. He got it when he was 48, or this is the age that he was, I think, when the statement came out or whatever kids were. No, he got it. Yeah, when the statement came out, he has $408,556. Death benefit option 1. This is his policy value, his total value. But look at that surrender charge. $6,995.13. So his net surrender value is only $10,430.84. They're going to steal $6,995 from him in this policy. Then, of course, right here, hey, the policy value, surrender value, and death benefit may increase or decrease in accordance to the investment experience, blah, blah, blah. These values may be recomputed, blah, blah, blah. It doesn't matter because his value and all that stuff, his policy value, yeah, it may go up and all of that, but it's still going to get hit with these surrender charges. So let's look at Kelvin Brooks' situation. Let's do a summary. He has 2 universal life policies. One he took out in 2014 and one he took out in 2019. 2 universal life policies. His total coverage, when you combine the 2 coverages together, he has $728,556 in life insurance. He has no coverage on his 2 daughters. no coverage on his two daughters, no riders, no nothing like that, no coverage on his two daughters. His total monthly premium, y'all ain't ready, $897.20 a month. That's what he's paying per month. If you break it down per month for 728,002 universal life policies, his total monthly premium is $897.20 a month. His policy surrender charges, his total policy surrender charge is $13,252.28. That's how much money his insurance company will keep of his money. His net surrender value is $19,921. He has death benefit option 1 on both, and this is his situation. But family, let's see what we can do for him. So if we took his program, he's got 728,556 with 2 combined policies. He got at age 47 and 41. He's paying a total of $897. We don't know what his cash value is going to be in 30 years. It's just going to be interesting. I don't know. We don't know what it's going to be. It doesn't matter because if he passes away, his family will not get the cash value. Are y'all with me? But his cash value, it ain't going to be that much. So for that same $897, if we did $750,000 in coverage on Kelvin, starting this year at age 49, we got him in a 30-year level term, his monthly premium only be $349. Y'all ain't fitting me. $349 a month coming in this many years later, giving him more coverage on a 30-year level term, $349 a month. Y'all ain't here. So that's a difference of $548 a month. Guess what? If we liquidated out his net surrender value of $19,921.55, and we invested that along with the difference of $548 a month, by the time 30 years at the end of his term, he'll have $1.3 million. Y'all ain't excited. Y'all ain't excited. And this is what I showed my homeboy. So which program would you want? If you were given a choice between the left side or the right side, which one would you choose for your family? Obviously, you'll choose the right side because the right side is the right side. But see, he didn't even know that the right side was available. And that's what I'm saying, family. It's people that we know, they don't even know the right side is available until we show up. Are y'all with me? And that's the power of what we do. And so if that's the program that you would choose, then obviously that's the program you would want to sell. But there's a lot of people out there that's trying to convince people like my homeboy that the left side is the best side. That's the side you need to be on. All that stuff that's circulating around social media, they trying to sell the left side. They trying to sell the left side, but the right side is the right side. Let me show you guys what we actually did for him. We gave him, check this out, $1,250,000 in coverage on him and $20,000 on each of his girls. Y'all ain't hearing me. We got him $1.25 million on him, $20,000 on each of his girls. His monthly premium is only $589 a month. Y'all ain't excited. That difference of 308, along with when we liquidate his cash value, if he invests that for the next 30 years and average about a 9% rate of return, in 30 years, he'll have $861,554, more than what his face amount is on his other policy. This is how we helped him. And this is how you can help the people that you know and that you love and you care about. And this is what we do. And this is why it's so important for you to understand the power of what we do and how we impact families. I'm telling you right now, guys, these are some recommended books for you. You saw me do one last week, Mortality Merchants. This is another one, another two, How Your Life Insurance Policies Rob You by a guy named Arthur Milton. I got that one on the way. I just received this one right here, What's Wrong with Your Life Insurance by Norman F. Dacey. You want to invest in these things because it gives more intel about trash value life insurance and why that stuff is taking advantage of our people in particular, Black and brown people, right? Why it takes advantage of us, all right? And I'm wrapping up. Primerica is starting to do a training series on different types of trash value policies. They just did a training last week on whole life policies. It was a powerful training. And during that training, they announced an upcoming training on infinite banking. It's going to be strictly on infinite banking. It's going to be on August the 3rd, 3 p.m. Eastern time, 2 p.m. Central time. All you got to do is scan this QR code and it'll take you to the registration for that training. It's a Zoom training. Or you can go on POL, Primerica Online, go into the products tab, life insurance, and click on the link that says upcoming webinars, and you can access and register for the training there. I was on the last training when they went over cash value. It was so powerful. I'm super excited to be plugged into this one too on infinite banking. August the 3rd, 2022, 3 p.m. Eastern time, 2 p.m. Central time. You need to be there. You can scan this QR code. I'll put it out there on Telegram, all that good stuff. You want to make sure you're in there. Also, coming Tuesday, August the 9th, mark your calendar. We're going to have a part 3. I know I said we're going to do 2 parts, man. We're going to stay in this bag because this is important. We got breaking down trash value life insurance. We're going to have our Primerica. We have our regional sales manager, Primerica's regional sales manager for this area, Xochitl Lopez. She's going to be a guest speaker on our training, and she's going to talk about different things when it comes to trash value life insurance is out there, and it's going to be good. It's going to be real good. So mark your calendar. It's not going to be next Tuesday because next Tuesday is Recognition Tuesday, but the Tuesday after that, Tuesday, August the 9th, we got our regional sales manager, Xochitl Lopez. She will be plugged in as a guest speaker to this training. And guys, it's going to be awesome. It's going to be dynamite. All right. Any questions or comments before we close out? Was this good? Did y'all learn something? If it's happening to my friend, it's happening to your friend. If it's happening to my family, it's happening to your family. I'm telling you right now, our crusade is more important than ever. There are people out there that are being hoodwinked, they're being swindled, they are being led astray, run amok, all the different phrases that we're familiar with. And unless we're out there on the front lines, educating people and empowering them, emboldening them, then I'm telling you right now, our folks is going to be captured by this stuff. Super J, talk to us, man. Let us know your thoughts.
Yeah, I was just going to say, the wool pulled over their eyes. That was the other one I want to add to run them up and all like this stuff like that, right? But has anybody ever heard, if you don't know your rights, you don't have any? Anybody heard that before? I mean, of course you have rights, right? You do. But if you don't know them, you can't really exercise them. Am I right in saying that? It's true, right? So the same goes for our business, right? If a client doesn't know, or if a person, right, doesn't know their options, do they have any options? They really don't have any options, especially if you're only showing them one option. And the option that you were showing there was those universal life policies, right? Where they feel like, hey, this is what I have to do. I got to get my money locked up. But if you haven't shown me another option, then that's all I'm really rolling with, right? So like we said before, I said this last week, I said our community, it's plagued with uninformed people and misinformed people, right? And an uninformed person, right? When a misinformed person gets a hold of them, that uninformed person becomes another misinformed person. So what I want you to do is think about the people that you know, love, and care about. The people in your phone, the people that you still saying, hey, I'm gonna wait to talk to this person. Let me try to find out a little bit more. Let me do this, let me do that. Are those people misinformed or are they uninformed, right? And the thing is if they're uninformed, you don't want another person to get to them to give them the wrong information. You know what I mean? Because you never know what could happen. So don't assume that people got it together either. Just because they look like they're rolling good, or they look like, hey, their occupation is where you want yours to be, or that you admire, right? You know, Coach used to say this thing back in the day that I've never left me. He said, they may be just a different shade of broke. Just a different shade. Because you don't know what it's looking like on the inside until you actually sit down and do a wealth builder with them, right? But I'm saying there's a lot of people that don't have it together, y'all. And a lot of people that are making good income, right, are these professions that Nick was talking about. They're getting preyed on the most. So just remember, we have the goose that lays what? The golden eggs, right? So we always want to tell that Primerica story, and we want to get this information to as many people as we can. Whatever they say, it doesn't matter, right? We have to get caught up in doing our job, right? And I'm gonna say this one last thing before I finish. The seed planter, y'all, the seed planter. And some of our teammates, they know where I'm going with this. The seed planter, they do not get caught up in the seed. Is this seed gonna grow, Erica? I don't know, man. If I put this in the ground, will it? I don't know. Will it take a week? Will it take 2 weeks? If they keep thinking about what the seed is gonna do, Crystal, they may never get around to planting that seed. Are y'all with me? They'll be out there all day, like looking at all these seeds, like, man, I don't even know. Are these seeds gonna grow? I don't even know. What the seed planter does is they do what they are in control of doing, which is planting that seed, tilling the soil, and watering it. That's all the seed planter does. And that's what we do. We plant seeds with our people, right? Whether they decide to do something about it, that's on them. But we cannot make decisions for people. Let them see it with their eyes, let them hear it with their ears, and let them make an informed decision about what they want to do, right? Whether their life gets changed or not, at least you were there to plant that seed. Are y'all with me? Well, let's go take care of it. That's it, Brandon. Let's go take care of business. That's all I got.
Excuse me.
Go ahead, Kim.
Awesome training, of course, as usual. But I just wanted to make a comment because I registered myself. But what I came up with was infinite banking, August 3rd at 6 o'clock. So I'm not sure if the QR code was correct, but I guess the best option is to go on the POL because that's how it came up for me. Someone else said that they registered. I don't know what they got, but mine says infinite banking and it says that it's at 6 p.m. So that's not the right one, but that's what
I got also. I got that also when I registered. In fact, I couldn't register because it said I had to be, they have 3 titles there, RVP and above, future RVP or office manager. So I couldn't check any of those.
Future RVP.
Okay. Let me see if it's going to go through.
Yeah, you are a future RVP. Hey, what I'll do is I'll do.
Mine went through. I'm
registered.
All right, perfect. Fantastic.
I'm registered too.
Fantastic.
Oh, it says the right title for you guys and the right date. Mine didn't for some reason. I don't know. I'll just go on the
What
POL.
I'll do, Kim, is I'll figure out the time and make sure that that's correct and all that stuff. That's what they put up there was that QR code for that time. And so because what I did, I just took a screenshot of that slide and we'll make sure that we got everybody set up the right way on that deal.
Okay.
This is a powerful training. I know it's going to be super legit. Make sure everybody gets plugged. I'm gonna put the QR code up here in a second and I'll also put it into Telegram. So everybody, if you can, make time for it. It's going to be impactful, talking about that infinite banking crap. And you want to make sure you know the nuances of that.